Good morning, guys. Welcome to Mug Briefing. NVIDIA walked onto its GTC stage on March 16th, 17th, 2026, and said the next few years of AI hardware demand could reach about $1 trillion through 2027. That number includes its upcoming Blackwell chips and the new Vera Rubin systems. And right away, that tells you something important. This was not about what NVIDIA has already sold. It was about what it believes could be sold. Here's where it gets interesting. Nothing in this event confirmed a large block of new revenue hitting the books today. There were no disclosed orders from Microsoft, Amazon, or Meta tied specifically to these new systems. No updated revenue guidance for 2026 or 2027. No clear EPS upgrade. So financially, in the near term, very little actually changed on paper. But the story NVIDIA told about the future changed a lot. Before this, investors mostly thought of NVIDIA as selling powerful chips used to train AI models. Now the company is leaning hard into inference. That's the phase where AI actually runs in the real world, answering questions, generating content, powering apps. Think of it like this. Training is building the brain. Inference is using it every second, everywhere. And inference happens at a much larger scale. So NVIDIA introduced full rack systems, not just chips, but entire bundles, GPUs, CPUs, networking, storage, even software sold together as one unit. Bigger systems mean bigger deals. Instead of selling a single chip, they're selling an entire data center block. That likely increases total contract value per customer. One sale becomes much larger, but it also changes the economics. Margins, which is basically how much profit they keep, could move in either direction. GPUs alone are extremely high margin. When you add CPUs, networking, and third-party components like Grok's LPUs, the mix changes. The system price goes up, but so do costs. So the question becomes, do higher prices outweigh lower component margins? That's not answered yet. Now, zoom out for a second. The $1 trillion number sounds massive, but most of it is not locked in. It's not backlog. It's not signed revenue. It's a projection of what the market could spend if AI adoption continues at this pace. That means a large portion of it is still aspirational. Hyperscalers were referenced heavily, Microsoft, Amazon, and Meta. But being mentioned is not the same as committing capital. We haven't seen confirmed purchase orders tied to these exact systems yet. The Vera CPU is also still early. Timing around production and volume shipments is not fully locked. Same with Grok LPX systems. They are integrated into NVIDIA's roadmap, but large-scale deployment details remain limited. So, what's confirmed? The products exist, the strategy is real, the direction is clear. What's projected? The scale of demand, the speed of adoption, the financial impact. And this is why the stock didn't explode higher. If this were immediate, guaranteed revenue, you would have seen a breakout. Instead, NVIDIA traded in a tight range around $180 to $188. Investors liked the story, but they're waiting for proof. Because here's the thing, a lot of this was already expected. The market already believed inference would become the next phase of AI. Analysts already modeled some level of system expansion. NVIDIA already trades at a valuation that assumes strong multi-year growth. So the $1 trillion number feels big, but for many investors, it may be more of a reframing than a completely new upside surprise. And this is why it matters. If NVIDIA can actually convert this into real orders, real shipments, and real revenue, then yes, revenue estimates go up, cash flows go up, and the stock could justify higher multiples. But until that happens, the financial impact stays mostly in the future. Now, shift perspective. For hyperscalers, this creates a trade-off. These full-stack systems simplify buying and deploying AI infrastructure, but they also increase dependence on NVIDIA. Switching away becomes harder. For partners like Grok, this could mean more volume flowing through NVIDIA's ecosystem, but it also keeps them in a supplier role, not a platform owner. For competitors like AMD and Intel, pressure increases. NVIDIA is no longer just competing on chips, it's competing on entire systems. That's a much harder battle. And for suppliers, memory, networking, this could be a quiet win. Bigger systems require more components. But that's only part of it. There are real risks underneath this story. If hyperscaler spending slows, this demand could shrink quickly. If supply chains get tight, shipments could be delayed. If cloud companies push harder on their own chips, NVIDIA's share could face pressure. And executing across GPUs, CPUs, networking, and software all at once is not simple. It increases complexity and cost, which brings us back to investors. If you own NVIDIA, nothing here forces an immediate decision. The long-term story is stronger, but the short-term numbers haven't changed yet. If you own ETFs like QQQ or SOXX, you're already heavily exposed. NVIDIA is a large weight. Its moves will drive your returns whether you realize it or not. And volatility may increase, because now every update matters more. Orders, backlog, supply, margins. So what should you actually watch? Look for confirmed purchase orders, not mentions, real commitments. Watch for disclosures on bookings versus backlog. Listen for updates on Vera's CPU sampling and shipments. Pay attention to hyperscaler CapEx guidance next quarter, because that's when this story shifts from narrative to numbers. And that's the line the market is waiting to see crossed.